Hello, everyone. We're excited to be here at Camden Central High School today with you. And thank you to Mr. McDowell and the entire faculty for having us here today. My name is Marcus Vine,
I'm Madeline Breeden.
and we're with Apex Bank of Camden. And we come today to share a few things we hope you will find beneficial and helpful as you will go along in your lives. This is Financial Literacy Week across the state, and we are here today to talk about the importance of credit. All right. So we've come to your school today to present a few things in a short few minutes, to do some things hopefully that will be helpful to you, instruct you as far as what the process of borrowing money looks like, and how it relates to the bank and how it relates to the borrower, because many of you, if you haven't done so already, will be getting jobs, you'll be purchasing automobiles, and in time will be purchasing homes. And so to understand a little bit about the credit process and how borrowing money works is very, very important. So let's get started in that today. And a few things that in this short few minutes with you that I would like to go over are these. We want to talk about the importance of credit and what the process of borrowing looks like. We want to discuss and identify some different types of loans so that you become familiar with them. We want to help you understand the loan application process. We want you to know what the bank is looking for when we consider making a loan. And then we want to give you some tips on what you as the borrower should consider when you are looking at taking out a loan from the bank, okay? So all of those things we'll cover together in just a short few minutes. So, you ready to get started? Let's go this morning. Let's talk about the importance of credit. And before we do that, let's define what credit is. Credit, in basic and simple terms, is the ability to borrow money. So your credit, or your credit history as it's sometimes called, is simply your ability to borrow money. Having good credit and maintaining a good credit rating is very, very critical, and it makes it easier and cheaper to borrow money for you in the future. So let's talk about the importance of credit. First of all, the credit is very, very important to the community as a whole. And why is that? So as a local bank, Apex Bank, we provide loans to businesses in our community who employ people who earn paychecks, right? So it's very, very helpful to the economy. In fact, making loans from the local bank helps to stabilize the economy and grow the economy. And every time that we make a loan at the bank, we're actually increasing the money supply in the local economy, which impacts businesses, individuals, so forth and so on. So you see how this is very, very impactful to the community as a whole. Secondly, credit is important to the bank because it's how the bank stays in business and operates. So if the bank is making good loans, the bank can stay in business. But if the bank is making what we consider risky loans to borrowers who will not or cannot pay us back, then the bank suffers losses. And the more losses the bank suffers, the more chances of the bank failing. And when the bank fails, it's not good for the community as a whole. But most importantly, let's talk about the importance of credit to the borrower. That's you and that's me individually as borrowers. Now, can a bank just make a loan to anyone for anything? No, obviously not. We have to be prudent in our loan decisions. We're going to talk a little bit about what we look for when we do our due diligence to see and measure whether a borrower can repay us. Okay? Now, as we talk about credit history will impact several things, and this is something to keep in mind as you go along. Credit history not only impacts your ability to borrow money, but credit history can have an impact on many things. It can have an impact on your future employment. So let's say when you go apply for a job, your potential employer could do a credit check on you, and that credit history may be reflective of what that employer thinks what kind of employee you will be or will not be. And it can cause you not to get a job if you haven't maintained a good credit rating and a good credit history. Same thing with insurance. When you go to purchase insurance for an automobile, or insurance for a house or a boat or a four-wheeler or whatever it may be, your insurance agent will more than likely pull a credit report on you, and that will influence the rate of your insurance cost or your premiums. If you go to sign a lease on an apartment, let's just say, your potential landlord could pull a credit report on you, and based upon whether that credit history is good or bad, may decide whether or not to rent you an apartment. So you see how credit impacts so many different areas of our lives, not just the ability to borrow money. So credit is very important to all of us as individuals. Next thing I want to do is identify some basic types of loans. Now, there are many, many different types of loans. We won't go into all the different types of loans, but I just want to hit 2 or 3 basic types of loans. One of those is a credit card loan. Let's talk about credit cards first. Now, credit cards will give you the ongoing ability to borrow money. In other words, if you have a credit line on a credit card, you can borrow money using that account, repay it, and then borrow it again, okay? It's generally what we refer to as an unsecured loan. So what is an unsecured loan? What does that mean? That means that there is no collateral associated with the loan. So now let's define what is collateral. You've heard that term before. Some of you perhaps know what it is. But collateral refers to the property or asset used to secure the loan. A car, a house, a boat, a recreational vehicle, whatever the case may be, to secure a particular loan. Now, what a bank looks to see when it looks at collateral is what is the value of the collateral, and if you are no longer able to repay the loan, will the collateral repay the loan? Okay, so collateral is very important. That's called a secured loan when collateral is used. Again, when collateral is not used or required, it's an unsecured loan or debt. Okay, so an example of an unsecured loan would be a credit card loan, as we discussed. It could also be a student loan. Some of you guys will be getting familiar with student loans before too long as you enter into the next phase of your education. Those are generally unsecured loans, okay? There's no collateral associated. Credit cards in general will have variable interest rates, okay? We all know what interest rates are. Interest is our cost of borrowing money. And so if a credit card has a variable interest rate, what that means is that rate can change over time. It could go up or down. But if it goes up, what it does is it negatively impacts your cost. It makes your cost more of borrowing. So that's something to always look for. Credit cards generally only require a minimum payment each month to be made. That gives the borrower the flexibility to make the minimum payment. That generally is just the interest and maybe a small portion of the principal. The problem with that is if you're not a really good disciplined manager of your finances, credit cards can open the door to only making minimum payments. All the while, your principal balance never gets reduced. And then if your rate increases, it actually increases your cost of borrowing. So just a word of caution on credit cards. You must be very, very disciplined to manage a credit card account well. Credit cards, when managed well, can be a good thing. But if you're not very disciplined, they can cost you a lot of money and a lot of problems and can negatively impact your credit. So be very careful with that. The second loan type that I want to talk about is a consumer installment loan. Now, a consumer installment loan is a loan to purchase a car, a recreational vehicle, home furnishings, improvements to your home, things of that nature. These are generally shorter term loans. They're monthly installments in that you pay monthly principal and interest payment each month. That payment doesn't change. You pay whether it's 60 months or 48 months, you pay the same payment each month in a consumer installment loan, usually 5 years or less. Another type of loan is a home loan. Now, home loans are a little more complex. There's a whole lot more to a home loan. We won't get into the details of that today. Maybe we can come back and talk about that a little later. But when you apply for a home loan, the first thing that you will need is an adequate down payment. And down payment is your portion of the purchase price. That usually is about 10 to 20% of the total purchase price of the home. So it's something that you definitely have to plan for and work towards. Buying a home is not something that's accomplished overnight. You have to plan for it, work towards it, save your money, plan ahead, budget, and make sure that you're in the right position, not only by having a down payment saved, but by making sure that you have maintained a good credit history, you have borrowed some money and established a credit history, and that you have repaid that on time, and it's a good, solid credit history. And once you do that, you put yourself in a position to purchase a home. Some of you will be doing that in the next few years. So a good credit history, as you can see, is very, very important with all 3 types of loans. Now let me talk to you for just a moment about what the bank looks at when we consider making a loan. So you come into the Apex Bank and you want to apply for a loan, and you apply for any type of loan, whether it's a consumer installment, a home loan, or even a business loan. There are certain things that we're going to look at. And I want to talk about the 4 C's of credit. The 4 C's of credit. The first thing that we're going to consider is character. See, you thought character just was something that you had to maintain through high school or maybe in church, but character also factors into your ability to borrow money. And it does. How does character impact that? Well, we want to ask certain things. Do you have a job? Do you have a reputation of being dependable on that job? Do you show up for work every day? Have you demonstrated that over a period of time? Are there any questions or concerns regarding your character and your conduct? Those are things that sometimes may be difficult to determine, but are definitely factored into the credit decision that the bank or the lender will make. So the first one's character. The second one will be credit worthiness. That's what we're talking about today. We pull a credit report on each and every borrower that comes into the bank. Now, that credit check will tell us several things. It's called a credit report. It will tell us who you are. It will tell us how much debt you have and who you owe. It will tell us, have you repaid that debt on time? Because it's going to give us a repayment history and tell if you've ever been late on those payments. And any other negative information that's associated with a credit, like a collection account that was unpaid or anything of that nature, a car that was repossessed, all of those things will show up on your credit report. So a bank will look at your credit report each and every time that you borrow money. So you have character, number 1, and then you have credit worthiness. Number 3 will be collateral, which we've already talked about just a little bit. But there's certain things that we're going to look at when we talk about collateral. What kind of collateral is it? What is the condition of that collateral? Because that's important. Are you the rightful owner of that collateral? So say you're going to come into the bank and you're going to take out a loan on a car that you own. You're going to have to provide proof to the bank or the lender that you own the car. My name's on the title, right? I am the rightful owner of that collateral. And then we're going to ask the question, is there enough value in the collateral for it to be deemed adequate collateral to secure this loan? If it's a vehicle, what's the value of the vehicle versus the amount of money that you're borrowing? Okay? Character, creditworthiness, collateral, and finally, the 4th C of credit is capacity. So what do I mean by capacity? Capacity is your ability or your capacity to repay the debt. We're going to analyze that. We're going to ask you about your job, your employment history, how long you've been on that job, what you do in that job, and then how much money you make. So you provide proof of your income. We look at your income. We already have your debts. We know what you owe according to your credit report and in our discussion with you. And we look at this thing called a debt to income ratio. And you will hear a lot more about that as you go through life, I promise you. Debt to income ratio is very, very important. What that is a ratio, and it's stated as your total monthly debts divided by your gross monthly income. It gives us a percentage, and we have certain thresholds that we generally don't go over. We generally do not go over 40 to 45% debt to income ratio. So we look at that, analyze that to make sure that you have the capacity to repay. So just to recap, we look at character, we look at credit worthiness, we look at collateral, and finally we look at your capacity to repay. All right? Now, here's a few things that the borrower should consider when taking out a loan. The first thing that you or I should do each time we take out a loan is we should look at the lender that we're considering and make sure that they're reputable, okay? So if we're going to a local bank like Apex Bank, we've been around since 1931, we're probably a good, reputable lender for you to come see, and we hope that you will. If you're going to a company that you're not familiar with, do a little research on them. There's lots of different loan companies out there. Some charge much higher interest rates, and you want to make sure that you've done your homework. You can't go wrong with a good community bank working with you, okay? The second thing you want to ask is about your interest rate. Is my interest rate, what is it, number 1? How much interest are you going to charge me? And is it a fixed rate or a variable rate? If it's a fixed rate, it cannot change during the term of your loan, meaning your payments cannot change. If it's a variable rate, the variable rate could go up. And in a rising interest rate environment, that means the cost of your borrowing goes up. Okay, so that's very important to ask. One of the things also that you need to ask is, can my payments change understand fully what the repayment agreement is. Okay, I've got 36 payments at $300 a month. That payment cannot change. Make sure of that and make sure that you fully understand the repayment agreement. Another thing to consider is what are the fees associated with my loan? What is the loan fee or any other fees that are associated with my loan? Ask the lender to give you an itemized list of what those fees will be so that you fully understand. And finally, what is the total cost of my credit or my loan? In other words, if I'm going to take out a loan for $5,000, what is my total payback after those 3 years? What does that number look like? I need to fully understand that. Can I do this? Does this fit in my budget? That's very, very important. Even if the bank or the lender says this fits within our debt to income ratio, make sure that you as the borrower are comfortable that you can make those payments. Can I make those payments now and in the future? So that's a little bit about what we look at, what the borrower should look at, a little bit about credit. And now we want to give you a little short demonstration of what the loan application process looks like, okay? Hello, Madeline.
Hi, how are you?
Good to see you.
Good to see you.
Been a while. Have
Yes.
a seat. So how you been doing?
Good, how are you?
Good. Thanks for coming by the bank today. How's your family doing?
They're good.
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 Your dad still working at the electric company?
He is.
He is? He still
Yes.
liking it?
Loves it.
Good. You know, me and your dad used to do some duck hunting years ago together.
Whew. I'm sorry.
So tell him I said hello.
I will tell him.
What can I help you with today?
I am looking to get a car loan today.
Okay. Very good. Very good. Well, you come to the right place, I hope. So are you looking at a new car or a used car?
A used car.
A used car. Okay, great. All right. Let me get a loan application ready here. And can you tell me a little bit about the car that you're looking to buy?
Yes, it is a 2020 Toyota Highlander.
Toyota Highlander. Okay. All right. And have you ever borrowed money here with us before?
No.
Okay. All right. First time? Well, we're glad that you came to us, and we'll do our very best to take good care of you and give you good advice and put you in a good loan. Okay. So, how many miles are on this car? Tell me a little bit about it.
I'm buying it from a family friend.
Okay.
For $27,000,
Okay.
and it's got roughly 20,000 miles on it.
Okay. Well, that's good. That sounds like it's obviously you've seen the car
Yes.
and it's in good condition, been well maintained.
Yes, sir.
All right. What is the total purchase price?
$27,000.
$27,000. And you realize there's going to be sales tax on this car to pay, right? Since
Correct.
you're buying it from a family friend.
Correct.
You've planned for that.
Yes.
Do you have a down payment on the car?
I have been saving up, and I've got around $3,000.
Good for you. Very well. So that's a little over 10%. That's acceptable. That sounds good. Sounds good so far. So the next thing we would need to do is do a credit application.
Okay.
And then with that credit application, you would give us the authorization to pull your credit history, do a
Okay.
credit check. Is that okay with you?
Yes.
All right. So let's just let's get a few things here underway. Madeline, tell me a little bit about what's going on with you now, where you're working.
Okay, I work at Apex Bank in Camden.
Oh, you do?
I
Okay.
do. I'm a loan
It's a
assistant
great
there.
place to work.
I've been there for about 6 years now.
6 years on your job. That sounds great. So you ought to know a little bit about the loan process
I
at
do.
this point, right?
Mhm.
Okay. All right. And did you bring your income records with you?
I did.
Perfect. All right. I like somebody that comes prepared. That's exactly what we need. And so what we'll do, Madeline, is take your income, we'll take your credit report and look at your debts, and then we'll calculate your debt to income ratio
Okay.
to see how that works. And I will enter these into the system. We'll let you know what that debt ratio looks like. And we want you to make sure that it's a payment that will work for you, okay?
Okay.
All right. I'll give you that piece back. And let me go ahead and calculate the payment for you. So we could do 60 months on a 2020 model Toyota Highlander, okay? The interest rate would be 6%, okay?
Now, is this a fixed rate?
It is a fixed rate. It
Okay.
will be fixed from the time that you make the loan until the final payment's made, which is 60 payments.
Okay.
And that payment would be, it looks like $454 a month.
Okay. I've done my homework, and this seems to be pretty fair.
Very good. There is a loan fee of $150.
Okay.
Okay. To go along, it's a one-time fee that you will pay. and you will pay 6% interest over 60 months.
Yep.
Do you have any more questions?
So my payment can't change throughout the loan.
Payment cannot change. That's correct. And I almost have your credit up here, your score. Wow, congratulations. Your score is 720. So that's a really good credit score. So you are approved for the loan.
Awesome.
Would you like to proceed?
Yes, let's do that.
Very good. Thank you.